Hello and welcome back to Life, Loss and Legacy, a Planning Solo podcast dedicated to helping people through the first 3 years after the loss of their partner. My name's Jordan Varker. I'm an independent financial planner, and I'm joined today by Phil Seath and Daniel Vicino, directors of SPIRE Business Services. Hello, gentlemen. Thanks for coming.
Thanks for having us, Jordan.
Hey, Jordan. Thanks for having us.
Now, I've asked Phil and Daniel to come on today to discuss the topic of estates and taxation, which, just saying that out loud, it sounds very dry and very dull, but as an executor or somebody going through those stages, that we're calling it the red light phase after somebody's passed away, it's a big factor. It's a big consideration. It's really complex. So thank you again for coming on. I might ask you both, actually. I'll start with you, Phil. Can you give us a really, really quick intro, a quick rundown of kind of your experience dealing with estates?
Sure. So I've been in public practice for 21 years now, and prior to starting SPIRE Business Services, I worked in another small, medium-sized accounting practice in Ringwood. And through that practice, we had a relationship with National Australia trustees, and we did quite a lot of estate tax returns for them and provided advice, deep dives into cost bases, all sorts of different things. And we continue to do that work through the current business as it is.
Daniel, we've done work together on clients, predominantly small to medium business clients. That's a lot of your expertise and experience as well, isn't it, in that sector?
Yeah, that's right. My main focus is the small to medium business clients, and I have done estates. I feel more the expert in this matter, and I certainly do estates, and I draw on Phil for the expertise on it. But yeah, I really enjoy working with small to medium business owners to help them grow their business. So.
And one of the big reasons I've asked you guys on is, obviously, I know that you know your stuff, but also the people I think we're talking through this podcast are the people that accountants never really see. They're the stay-at-home director, paper director, who's signing off on all the documents but doesn't understand what it means. Mm. And I think for those people, when the financial partner passes away, they're then in a very intimidating and confrontational situation where they need to ask questions of somebody that they always feel like they should know the answers to. So it becomes very awkward. So I really want to bring it back to really fundamental stuff to give them that knowledge to have those conversations. And I know you guys are the right fit for that.
Sure.
There's three main areas I want to cover today. Firstly is how are estates treated when it comes to tax? Mm-hmm. Talk a bit about the specific taxation points, because there's triggers and there's considerations that come along. And then the tips and the traps for the executors, the administrators, and the people that are stuck in that kind of tornado of admin. So we might as well hop straight into it. And we'll start off with that idea of how are estates treated when it comes to tax. And I'll ask possibly the simplest question I can think of, and this one's to you, Phil. Mm-hmm. Does an estate have to pay tax?
An estate will pay income tax after the passing of an individual. This is based on the presumption that the person passes away with assets that generate investment income. And if that is the case, whilst the estate's being administered, the trustee or the executor will be responsible for preparing tax returns and paying any income tax that comes from that. There might be franking credits on dividends that cause it to be refundable, but certainly the income of the estate will be assessed.
So if we can unpack that for a bit, let's as an example say somebody passes away and they've got $1 million in ABC shares. And those ABC shares generate a dividend of 60 grand in a year. Yep. Person passes away, that 60 grand a year now is getting paid into the estate bank account.
Yep.
That estate will then...
Trust, in some cases.
Into the lawyer's
trust account in some cases too. Yep.
So it'll go somewhere. And then that's... Did I say 50,000? 60,000? 60. That $60,000 is then taxed as income in the hands of the estate.
Yes, it is.
Daniel, with that, what are they taxed in the way that sort of you and I are taxed as income, or is it taxed in a different, like, is there a flat tax rate like a company has, or how is that calculated?
It's the marginal tax rates of an individual. So the way that it works is for the first 3 financial years after someone passes away, the executor has, the Commissioner of Taxation has the ability to treat income where no beneficiary is presently entitled at the concessional rates, which are basically just the marginal tax rates that apply to any individual, less the Medicare levy. The little nuance to that is that once the estate is technically administered, income would then need to be distributed to the beneficiaries of the will.
Okay, so our phantom holder of ABC shares, or our deceased holder of ABC shares, their estate, they've got 3 years of collecting that income while they finalise the estate. You know,
Yes.
the nephew puts in a dispute and there's this and that, and the money's sitting there. They're doing tax returns in each of those 3 years?
They are, yes. But it's not 3 full years, it's 30 June. So if someone passes away on the 28th of June, it'll be that 30 June of that particular year, and then 2 after that. It doesn't mean it stops after that fact. What happens is if the estate's not administered within 3 years, there's another set of rates that apply after that. What those rates look like, they're a very specific set of rates, but they look a little bit like a blend of the minor rates, the non-resident rates, and then getting into higher incomes, just the ordinary marginal tax rates.
You said something earlier. You said concessional rates, and then them being the marginal tax rates, which I think it's worth flagging there. You mentioned minor tax rates. They pay, there's a penalty rate that applies to that. It's not punitive. We won't call it punitive, but it is quite high. Non-residents pay a higher tax rate, and then you've got your higher income earners.
Yes.
I think I rushed into a point here. I want to take a few steps back as well. We're talking income tax. Other sources of revenue within somebody's life are taxed differently. So, Daniel, you've got the income tax. Can you walk us through what's the other form of tax that people may come across in this?
In estates, or?
Yeah, I mean, we're all talking about income tax now, but we're kind of leaving the other big one from particular transactions off the table.
Yes, that's right. Capital gains tax. Yeah, I mean, that's the other big one in this situation. That's where it gets quite complicated as well. Well, it's not complicated, but there's certain rules around the capital gains, and there are certain ways to avoid capital gains on certain properties and things like that as well. So
I'm going to pull on that thread a little bit. So I'll come back to our person that owns $1 million of shares. They've got the income coming in. They're paying tax on that. It's being done over those 3 financial years. That's being done by the executor. That tax that's payable, and just for round figures, let's say it's 60 grand of income, they have to pay $20,000 of tax. Where does that come from? Is the executor having to reach into their pocket to stump that up, or do they draw down on the estate bank account to do so?
Option 2, they draw down on the estate bank account.
There would be scenarios where the estate's insolvent, though, wouldn't there?
Potentially.
Does the tax office then become a creditor to the estate?
Yes.
And can that liability extend beyond the estate into the executor's life?
That I do not know.
I'm going down rabbit holes, guys, so forgive me. I'm kind of dragging you along because I'm just like, okay, I've got that thing. I think we all have this affliction. Anybody practicing in any sort of space, you're like, okay, what's the very worst thing that could happen?
Yeah.
1 in 1,000 times.
Lawyers, Jordan.
Yeah. Too much time around them. We had a lawyer in one of the episodes, Kelly Gatehouse, who talked about estate admin, and she reminded me that something like life insurance can't be used to clear estate debts. It has to go through the beneficiary's hands. And then that kind of prompted, I think she had seen a few insolvent estates in that scenario where like $1 million is paid out, but so-and-so owes X amount, and they just can't reconcile the two. And so the estate just gets wound up, and it's really, really awful. But, so the tax office becomes a creditor to the estate then, and that just gets resolved.
Yes.
We were talking a little bit before we started recording that we're talking right now about federal tax, but there are other taxes that kick in. So just before we get too far into it, is there a consistent application of taxes nationally in Australia? No.
Federally, yes, when we're talking about income tax, and state-based taxes, no. Each state is responsible for collecting revenue for things like stamp duty, land tax if there was a property that continued to be held, transfer fees, etc.
I just thought of a question around land tax, but it's Victorian only because land tax is such a hot topic in Victoria at the moment. So we'll leave that for now. I think the takeaway from that, and the takeaway from this whole series, is get professional advice, because no matter which state you're in, or even where the assets are held, if it's cross-jurisdictional, you're going to need extra assistance. Do not try to do it on your own. Contact people like Phil and Daniel and get that extra advice. Okay, to come back to the nuts and bolts of actually the taxation of an estate. $1 million, 60 grand getting paid out, capital gains coming in, things like that. There is a thing, I'm sort of scratching at the surface here, but there's a thing that if you distribute the estate too early, that tax can become an issue for you as the executor. Is that a federal thing?
Yes. So basically what that means is that an executor's responsible for doing all of the due diligence with collecting the assets of the estate, ascertaining what the liabilities are, and then making provisions for that. So that, when we're talking specifically about income tax, that would mean doing due diligence about what tax returns have been prepared in the past. Are they up to date? Is there anything payable? What is the situation, not just with the estate tax return, which we're talking about after the person passes away, but the tax return, the final tax return of the deceased person. Also, is there any tax to pay? So the executor's responsibility is to take great care with what they're doing and make sure that they're conservative in their approach. And in my experience, this is always the case. Generally, there is a solicitor involved in estates with meaningful value that might be assisting in collecting funds or providing use of their trust account, etc. And through that process, there's a great deal of conservatism that takes place. I have experienced people that have passed away with significant numbers of income tax returns that are due, very likely to be payable. This is just one example is a client who had been selling down parcels of shares that they themselves had inherited and using that for, to fund their lifestyle and doing that each year and then not lodging a tax return.
Oh, man. Okay. You've preempted, because this was something I was curious about, actually, is what happens in that case. So in that case, for instance, say they had 10 tax returns outstanding, what would you guys have to do in that case?
Well, firstly, we would assess what information the tax office has on behalf of that deceased person. And a really important point to make before I talk about what we would do is, we might get to this in tips and traps later on, but it is increasingly difficult to get quick access to a deceased person's tax affairs. Once the person passes away, the agent-client link is broken, and it's then up to the legal personal representative to re-establish that relationship. So they will go through a process of telling the tax office that the person's passed away, and then they will then have the ability to re-nominate the tax agent again. Once that's been put in place, we would then go and look at what information the ATO has about those years. We might need to make a request for further information for years that are before the time where the ATO kept pre-filling data. And then we would do a lot of hand-holding to do things like reconstruct cost bases, identify dividends that might be received, and create, a reasonable reconstruction where information and records are very vague.
Leading off that idea, I think there might be people listening that are in that situation where things are really vague. Like they don't have. I mean, we've got a client at the moment. We're trying to get their share portfolio sponsored over to a broker portal that we use to avoid their estate having to worry about all this. And reconstructing that data is a real pain in the neck. Let's say, Daniel, reconstructing anybody's portfolio is going to be a hassle, but say somebody came in with 5 tax returns outstanding and they had shares and they had things like that. What's a reasonable time frame, do you think, that somebody could expect for those 5 returns to be finalised?
It depends on how, what data they do have. To get those 5 returns finalised, to chase up, that's all, I guess, reliant on them to get the data. So for us to do 5 returns, I would allow a month to a month and a half, maybe, if we had the data. We can even get them done quicker than that. But I've had to reconstruct. I've had to reconstruct a family trust that existed, and no one knew any information on assets in it, and because the person deceased, and so we got there in the end. But it's a matter of talking to other family members and talking to previous accountants and even solicitors as well, who did settlements and things
And
like
look,
that. So.
to set the scene also about the involvement of the tax office, even if the tax office is one of the bodies that you need to go to ask for that information. If we're talking about years that are pre the generatable pre-filling reports that we have access to, they have a 28-day service standard alone on that, and you won't find them issuing documents before the 28th day on many occasions. And in this particular circumstance, we've requested the set of documents on 3 separate occasions. And we've hit the 28th day of the 3rd occasion midway through June. And I still haven't seen the documents for this. So this particular scenario is well over 12 months. And really it's about just constant communication with the executor to explain what's going on and make sure that the expectations are set and understood.
And I think that flows on then as well, because the beneficiaries are in their ear saying, "Where's the money? Where's the money?" And there's that due diligence and that competence that has to be exercised to make sure things are done properly. Quick spot question: of the different assets, so listed shares or property, which one's harder to reconstruct a cost base for?
It depends on the property, but
honest, there's probably more complexity in a property cost base because of the nuance of the type of spend. In what element of a cost base does that form? Is it deductible? What's happened with the property before? There's a lot more nuance there. There are records and the ability to just use simple formulas to reconstruct share cost bases, whether they've got periods of dividend reinvestments, etc. I would find that easier, and I find both of them are, you might laugh, but they're relatively enjoyable puzzles to put back together. But
speaking like a true accountant,
the property side is the harder of those two.
And I think we're dealing with the registries at the moment to reconstruct one of these holdings, and probably to avoid slander, I won't comment any further. But there are easier organisations to deal with when it comes to our work. I'm trying to wrap it up.
Starting position, Jordan, it's often really, really difficult.
Yeah.
If you've got a starting position to go with, it makes it much easier, and maybe then you can reconstruct yourself without having to go to the registry. But if you've got absolutely nothing except an end position, it's very, very tricky. It's
really challenging. I think one thing that's coming through is that it's not unusual, this kind of thing. Like this is a very common occurrence, that you have some challenge or complexity. And it's going to become more common as people pass away and they've had holdings for longer and there's more wealth. So I think for anybody listening, just yours is not an unusual circumstance. It'll just be one step at a time and then it'll be resolved, but don't expect it to be done suddenly. I mean, the 4 to 6 weeks you flagged, Daniel, that sounds really, really quite rapid to me. To see what can be done out there. But I guess it relies on that data coming through, right?
Yeah.
Absolutely.
I want to move on to some of the more specific taxation points and just try to hit a few areas that might be familiar to people. But before we do, are there any other introductory basics that you think people should be aware of as they wade into the estates world?
I think I've already touched on it, and the most important one is just being willing to engage, work out whether or not the person that passed away had an accountant, being willing to engage with them, understanding that it's going to take some time to reconnect that relationship and that information might not be available as quickly as you like. And, as you say, there are definitely pressures from beneficiaries. Every person and every estate is different, but there's pressure because people are aware that there might be something coming, and, they might make a decision about what they're going to do with it earlier. And
they might spend it before they've got it.
Correct. Puts pressure on everybody. And so that is extremely common. I would recommend that people just relax, take a breath, and, that it is generally a longer journey than shorter.
Mm.
And you would just want people to have patience with the executor. It is a fair amount of responsibility and a lot of administration work, a lot of hunting through in an emotional time.
I guess it would be on that, the advice would be to choose your executor carefully. Because there'd be a lot of pressure, a lot of stress. You want someone who can react quite well under that. So,
we had David Patkin on, and he's talking about being an executor, and he said what a lot of people don't realise is you can renounce it. But so if you think you are not up to it, and if you reflect on it and you realise you can't do some of these things, then by all means renounce it and find somebody who's maybe more suitable and more comfortable with it, because it is a big responsibility. If the interaction between what you guys are doing, the solicitor and the executor, are there clearances? Is there privacy issues you need to be conscious of as you navigate around that to talk to the solicitor, or is it pretty straightforward?
There is definitely absolutely.
So the executor would have to sign off on that on behalf of the estate?
Not necessarily sign off, but the executor might be the one that needs to make the introduction. You need to be very careful about the sharing of information, the requests. Generally, I would say that people just make sure that the initial introduction is made, the parties are connected together. This is done by way of an email and a CC process, and I think that's generally enough. It's not like the tax office where you need to provide probate in order to be able to do things, nor with share registries, which is the same. Anywhere that you need to go that is requires identification of you as an executor, that's going to be quite difficult. But that close network of advisors can generally happen quite quickly.
And for beneficiaries that might be listening, or executors that are trying to keep beneficiaries at arm's length, is it fair to say that you're not allowed to release information to a beneficiary directly? Because they don't have any administrative role in the estate, do they?
No, they don't. They need to, if they've got questions, they need to speak to the executor directly.
Yeah, so just being really clear on that, because I think sometimes beneficiaries can become a little bit entitled and expect more than they're actually entitled to. So that's something to, I think, flag.
Not uncommon, Jordan, for them to reach out and maybe want to understand. They might not have a tax accountant themselves. They might want to say, look, can we talk through what the tax consequences of X, Y, or Z might be? And you might be at times providing a scenario or a summary or a piece of advice to the group. Generally, that only happens by way of being asked by the executor, and again, the beneficiaries being included in an email chain or something like that to make it quite clear that that's at the request of the executor.
There's something I'm interested in. We'll definitely come back to that, because I think defining the relationship, it sounds very semantic, but I think defining the relationship is important for you guys and for us as well. But because the beneficiaries will be entitled to certain assets or certain money, and they might be able to choose how they receive those assets. But there's different tax consequences. Now, you're not their accountant, though, are you?
No, not necessarily. It is the case sometimes you might be an accountant for a family group, and there is a connection across varying generations, and therefore, yes, you are their accountant, but quite often you're not.
So that advisory piece that, you should take this asset for this reason or that asset for that reason, that becomes
we wouldn't provide that advice without them becoming a client, and then we would have to be very clear about, maybe we would allocate that work differently within the practice.
I was just about to say that, yeah. The two of you.
Peace of mind. Yeah. I don't mind providing black and white factual scenarios that demonstrate what happens if you do this, and then they can use that information themselves. But the advisory side is, another step.
It's one of those things as well, Jordan, that we would probably get someone like you involved as well at that point to make sure that they're doing the right thing with that money as well. So not just from the tax perspective, but...
And I think it's becoming tacky now. I keep calling back to other episodes, but we have one that's about collaborative estate disputes. And I've done collaborative divorce before, and it's really easy. Not easy, but there's two parties. It's simple. Collaborative estates, all of a sudden you've got 4, 5, 7 parties and they've each got an advisor. You need a boardroom to actually have the discussion. It can get quite complicated. But yeah, I think keeping it focused can be very difficult. Let's roll on to some of the more specific tax points. And this is hopefully I'll just be throwing straight questions at you. By all means, tell me that, go away, Jordan. That's a silly question. That'll never happen. We're hopping into the weeds now. So for all the tax nerds, hopefully they hang around. So the income's taxed within the estate. We've covered that. When we were talking about dividends earlier, Phil, you mentioned franking. Now let's bring that back a little bit. Publicly listed company, shares are paid into the estate. Can you walk us through the franking and how that works?
Yeah. So for those that are not familiar with receiving a dividend from a public company or from any kind of private company for that matter, where there's been tax paid by the company and they've decided to frank their dividend, what that actually means is they're attaching the company tax that's been paid as a credit when the dividend is paid. So in your example of 60,000, there'd be a franking credit attached to that. That credit is then utilised. The income and the credit are added together to form the assessable income, and the tax credit is then allowed against whatever the income tax at that particular entity's tax rate.
It's to avoid paying the tax twice, isn't it? So the company pays the tax once, and then you get the credit for that. I was thinking through the marginal tax rates, but I think, that might be a bit too far in the weeds. I don't want to trigger any advice issues. You mentioned private companies. So, Daniel, can you walk us through some of the income that can come out of a private company as sort of an introduction, and then we'll hit the tax side of that?
So, private company, you could have the director's wages coming out of there, and then you've also got dividends. But dividends can come out in the way of a cash dividend, or you could have had the director or shareholder just taking drawings out of the company, and then to avoid further issues with Division 7A loans, which we won't go into now, but you pay a dividend out to clear them out. So as in, you can't take money out of your company without paying tax. So in some way,
sooner or later they get you.
That's right. So that's pretty much the only way of getting money out of the company, drawing it out, or wages or dividend, really. If it's a trust, it would be a distribution.
And we are going to come to family trusts, and we will try to keep it high level because I know how complicated this can get. But you mentioned Div 7A.
Yeah.
And this is something I think people can be quite surprised by, is that, maybe their husband had a business for 20 years and they were living a nice income. But it turns out that the whole time they were drawing it out as drawings, and their accountant maybe wasn't too diligent on making sure that was paid out. Mm-hmm. So if I've taken out of my company, I take out $100,000 as a income, quote unquote, but it's all been done as drawings.
Mm.
What does that $100,000 become within the business, within the company?
It's a loan.
It's a loan, yeah. So it was in the balance sheet. It becomes a loan at the end. So at the end of the financial year, if it's sitting there as $100,000 in the balance sheet, then that's a loan that loan starts, and if it can be paid back by the time you lodge the tax return, and then you haven't got any Division 7A issues. If it still sits there by the time you lodge the tax return, then we need to calculate interest, and a minimum repayment is required by way of a dividend. So,
and if I do that 10 years in a row, all of a sudden I owe my own company $1 million.
Yeah.
And I'm paying interest on that. I die. What happens to that loan? And we can keep this high level because I know there's multiple outcomes.
That's a good question.
It'll be part of the estate liabilities.
So my company will come to my estate and say, you owe me $1 million. And the reason we're going through this is because this does happen, and I think this catches people quite by surprise. The company still got that as an asset, so it's still worth something, but you owe them, or the estate owes them personally. The long and the short of it is that if you see a Division 7A or a director's loan or something on the balance sheet, get specialist advice.
Absolutely.
Yes.
Yep. Yeah. And not just accounting, like you.
And there'll be a lot of, again, expectation. There'll be some education and expectation management around what needs to happen with that. And there'd be very little strategy left if that was what you were presented with.
What's the interest rate now? Is it a GIC rate, or is it a different one?
I don't know what the benchmark rate is.
Yeah, what is it?
But it's not low, is it? It's higher than a mortgage.
Yeah, absolutely. Yeah, absolutely. Yeah.
And I think, Daniel, to your point, like, they're going to get you either now or later. You are going to have to pay that tax. So,
Yeah.
Okay, so let's move on. Like, say the person that's passed away had a few investment properties. The rental income that's coming in, taxed as normal income. Are there any provisions or anything specialties that people should be aware of? No. It's just straightforward income coming in. Now, Australians love a negatively geared property. But that loan has to be repaid upon death often, doesn't it? So there's no tax deductions that are likely to come out of that, is there?
Not out of the repayment of the loan itself, no. But again, like you mentioned before, Jordan, these things don't necessarily just happen at the click of the fingers. It would be a requirement that loan is going to be repaid, but you'll need to sell the property in most cases in order to be able to. Sometimes you might have enough cash that you can make that choice to pay it out and retain the property, but most cases it'll be that it needs to be sold.
Now we're going to wade into an area, and this is, I have to confess, a lot of ignorance in this space. Family trusts. Husband and wife, they're both let's say there's no corporate trustee. They're both the trustees of the family trust, and they're both the beneficiaries. Husband dies. What happens to that trust? Does that have to be wound up?
No.
So it can persist. In this case, she can remain on as a trustee and beneficiary.
There are other roles to be cognizant of. One is the appointer. You would need to make sure that you still had an appointer and that the person that passed away wasn't the only appointer, the sole appointer. Yes, there's nothing. The trust is a completely separate entity.
What happens if the appointer dies? If that's who died?
Provisions in the trust deed that state. So there are occasionally a bit of a waterfall clause within trust deeds that says, what happens if the appointer passes away, it goes to this person or that person or to the legal person or representative. Otherwise, the trust deed will have statements within it about what happens and what process. Each deed will be different.
I have come across some instances where how was it put to me? The beneficiary was entitled to a distribution. So the trust was to pay the beneficiary an amount of money, but they never drew the cash out. So what they did on paper is the beneficiary ended up lending that money back to the trust.
Yep.
What's that called on the balance sheet of the trust?
It depends.
Oh, good.
Yeah.
If the accounting has been done to the minute degree, that will be a loan. Otherwise, it will be an unpaid present entitlement.
So that's also the UPE. So that's what you'll see. Okay, so it's unpaid present entitlement. Okay, so trust distributes money to Mr. ABC. Mr. ABC puts it back into the trust. This is all theoretical. This is happening that the money stays in the trust. Yep. Builds up a UPE of X. Mr. ABC dies. What happens to the UPE?
Well, that's then owed to the estate.
Form part of the estate, yeah.
So that becomes an asset of the estate.
Correct.
Yeah. So for people going through this at the moment, that means the trust may have to sell down assets to release enough cash to have that paid out. Can the estate forgive the loan? No.
You'd need to consult the debt forgiveness rules. And if that were the case, then there are quite a lot of technicalities that happen, including the fact that may be a capital gain. You'd have to be assessing a cascading scenario of application of capital losses. It's quite complicated. But
and hopefully it comes through that I have no idea what I'm really talking about in a lot of this. And so I want people listening that if you feel overwhelmed by it, That's completely fine and completely normal. But what I would say is that your advisors should be talking you through these things the way that Phil and Daniel are now. There is a lot of complexity here. And if you're not getting that, if they're maybe talking down to you or talking over your head, I would, cautiously be recommending you speak to other people, because this is very hard. But you will get a lot from understanding it as much as you can, rather than getting pat on the head and say, no, love, it'll be fine.
Mm-hmm.
Try to follow it as much as you can and deal with people like Daniel and Phil to do so.
Jordan, I should say, sorry to interrupt.
That's right.
I should say that Phil and I are also, we probably, in some points, will need to refer to a specialist as well. So we know enough to know where the issues lie, and we can answer a lot of the questions, but there are specialists that deal with certain things as well. So that's when we would refer to them.
I think that's a really good point. I think if you're dealing with somebody that thinks they know everything, they're wrong. There's so much complexity here. Like even just what we're talking about there with UPEs out of a family trust. If I read what we just said on paper, I would have to read that 3 times, I reckon, to try to work out what had been said. You want to be dealing with people that know when to go and get external help. One of the clients we've been working with, Daniel, you just organised external help on a very specific taxation question. Fantastic outcome. Like it's just given them real peace of mind. That's really important.
And that scenario comes to mind when we're talking about deceased estates, even because there may be companies and businesses that need to be sold. There may be considerations that need to be, accounted for. And again, specialist advice isn't necessarily a bad thing. It's about knowing when to go there.
Not getting it is more expensive generally.
Absolutely. Yeah.
Let's hop into the income tax returns of the deceased person. They die on the 24th of December of a year. They will have to do an income tax return in their own name, would they? Yep. Up until that date.
Correct.
And then from the 25th of December till the 30th of June, it's an estate income return, tax return.
That's right. Yeah.
Even if, how do I put it? Even if the estate, like the will isn't finalised, probate isn't granted for 3 months, etc., it's still from the date after when they died.
Yes, it is.
Okay, that makes sense. You mentioned 3 years earlier, Phil. So they've got 3 years to finalise the estate, and if they don't, it falls into those higher tax rates.
Correct.
What's one of the longer estates you've seen? I'm asking this of everyone just because it's so fascinating to me.
Look, not much longer than 3 years.
Okay.
And that particular estate had life tenancy issues, multiple property issues, disability involved in the family, quite a lot of complexity about physicality in terms of, what property do we sell this person has, and it became complex in negotiating what that looked like. Generally speaking, nobody wants to have this ongoing for a period longer than that. The only times where it goes significantly longer is where the will establishes a testamentary trust. That is another conversation for another day. And it's not uncommon, but basically that allows the wishes of the deceased person to continue on in the form of a trust for a long period of time. But again, that you would be looking at that as having sort of wound the estate per se up and transitioned into the testamentary trust process.
It's a different entity then. It's a different existence.
No one wants to be dealing with this for a long time. The beneficiaries don't want to be asking questions all the time. The executor doesn't want to be fielding them all the time. I do speak to a lot of people that find a great deal of stress from it, especially those that may not be part of the family, because they then get a lot of pressure from family members from the beneficiary. I can recall one that I dealt with through COVID that was quite difficult because of access to records, and again, it was mostly about just mediating and navigating that conversation with beneficiaries about, well, we want this sorted now, and helping the executor have the right language to explain, well, we need to wait for this, or we need to do this, and often they'll be having to say, the accountant says this or the lawyer says this, and we've got pretty broad shoulders in that regard.
And one of the things we spoke about prior to putting on the recording again is that state-based differences, because executor responsibilities and timelines all differ. So you do want to wrap it up fairly quickly. Just as a way of conversation, I was talking to someone the other day what happened? The grandfather died 25 years ago. The farm passed to the next generation, and the next generation has now died, and the farm's now falling into his estate. Turns out they never transferred the property from the grandfather's name into the next generation. And when I heard that, I just, good luck. Good luck. That should be fun. Should be good. So another big one that comes up, and I think people make assumptions about this, so I just want to clarify. I own a home with my wife. I pass away. Does my wife have to pay tax on the house?
No, is the simple answer.
There's no capital gains tax. There's nothing like that. It just transfers.
Yes.
Yep. Point of fact, I mean, there's distinctions around tenancy and things like that. Get advice, etc., etc. But on the whole, you will not pay tax on the transfer of your family home into your name upon the passing of your.
No, as long as you're a dependent beneficiary in the will. Yes, correct.
Yep. Good. So I'm trying to limit the thinking. Well, that's quite a sentence.
No.
We'll put that in the social media clips. Trying to limit my thinking. I want to come back to capital gains tax. Capital gains tax is something that I think we always think of very instinctively because it's something we try to avoid for people. But it is a reality that in an estate, there is going to be often capital gains tax payable. As an overall reality, is there an overall statement we can say when the capital gains tax is going to be paid? Is it payable upon death? Is it payable upon administration? Is it payable upon distribution?
It is not payable on death. There's an automatic rollover. There is a really distinct change to cost base information and makeup at the time of death. And what I refer to there is if there's assets that were bought in the pre-CGT period, pre-1985, then what happens is those assets, they're inherited at the date of death and at the market value at the date of death. All other cost bases are as normal and they just roll through. But the cost base for any assets that were purchased pre-1985 is reset to that.
Can I put an example around that? Because I think that's a really, really good point. I bought a house, the classic example you hear in Melbourne is I bought a house in Oakley for $50,000 in 1980. It's now worth $4 million. I pass away today. The house, for taxation purposes for my estate, is not worth $4 million, is it? It's the estate cost base of 50 grand way back when. Have I got that right?
No.
That's exactly wrong, isn't it?
It's the opposite of that. Yeah. Let's throw some more what ifs into the scenario. Let's say that this was an investment property and it was used as an investment property for the whole time. So we'll take the main residence issue away. If that property's sold by the executor during the process of administering the estate, the cost base is the date of death. Sorry, the market value at the date of death. Any uplift after that time frame is what would be the capital gain. We're resetting the cost base. We're allowing the deceased person to have the full life of the CGT-free asset, and as soon as they've passed away, the clock starts at that value on that date and moves forward. So if that house was not sold by the executor but was transferred to a beneficiary, the beneficiary would inherit that asset at the date of death and at that cost, at the market value at the date of death.
So it's quite a generous provision, really.
Yeah, it's quarantining that tax-free period for that person for their life.
And then the property, $4 million, gets passed on to the beneficiary directly. The beneficiary sells it in a couple of years' time for $5 million. The $1 million difference is the taxable gain.
That's right.
You mentioned main residence exemption.
Yeah, I did.
Let's say lucky beneficiary lives in that property from that $4 million to $5 million uplift. What difference does that make when it comes to tax?
Just work this through in my head. I think that is just a straight main residence exemption.
And just, Daniel, can you run us through what the main residence exemption is while I try to unpack the next set of questions?
Your brain starts a challenge. So every person or I guess a couple can have one principal place of residence or main residence. And that is not taxable. Sorry, Phil?
At any one time.
At any one time, that's right. And that is not taxable. There's no capital gains on that property. Unless it has been, going to bigger issues here, unless it has been rented out in the time that they've held it and they've moved into it, there's different rules there. So if it's ever not been their principal place of residence, or it becomes, it starts producing income, there's different rules there as well. So you will have capital gains for a period of time when that is the case.
Importantly, that also includes things like using it to run a business. Absolutely,
yeah.
So it's the technical word is when it's being used to produce income, whatever that income might be, rental income, produce, as I said, being used in the production of income in a business. Even if the business doesn't own that asset.
So just to flag that for people listening as well, I think kind of what you're referring to there is that scenario where somebody has maybe been working from home and claiming a tax deduction against their maybe mortgage repayments or running costs of their family home. That's
substantial than the ordinary home office type claim.
That's a red flag that you should be conscious of. So just be very clear.
And again, it's another due diligence thing that an executor needs to make sure that they're aware of is what has the house been used as through the ownership period.
For people not watching the video, I'm grinning because I'm thinking back. I've mentioned this previously. This is completely off topic, but 5 or 6 years ago, I was very bored with financial advice. I thought it was really simple. It was really dull. We were just doing like income protection and super stuff. Just this conversation is why I love it now, because every question we're talking about, it's like if there's a flow chart, it's all of a sudden it branches out, and then each one of them branches out and branches out. And it's just, there's such complexity and depth here that for us as professionals, it's wonderfully interesting and intricate. But for executors and beneficiaries, it must just be a nightmare because it'd be just completely different language. Hopping across from that sort of particular asset stuff, let's talk about superannuation very briefly, because it's not an estate asset. But are there any taxation considerations that people should have in mind about a standard super fund? We'll come to self-managed super after that.
Yeah, there are. The most common one is navigating payment to a non-dependent beneficiary, which is taxable. If it goes directly to that non-dependent beneficiary, then it's taxable, and the tax paid would also include the Medicare levy. If it goes to the legal personal representative of the estate and then gets distributed in accordance with the will, it doesn't. So there's a little bit of planning there, but increasingly what we're seeing is people considering ways to mitigate that by tackling the withdrawal of their superannuation in their life when they're in control of it, rather than worrying about what might happen and who might pay tax if they pass away. It's a live question I have with a client right at this very minute, and it comes up quite regularly when we talk. When anyone's going through, a will review or estate planning, retirement age, lots of conversations you'd be having with people.
Yeah, the odd recontribution. But also we're seeing a lot more educational content or warnings around sort of deathbed withdrawals. It becomes, like you said, it's a very live topic at the moment of how that can be treated.
Yes.
Self-managed super fund. So husband and wife are the trustees of the fund. We'll say there's no corporate trustee again. I'm trying to keep these as simple or as usable as we can do it. Husband and wife are trustees of the super fund. They're both members of the fund as well. Husband passes away. What are some considerations for the surviving trustee?
Do we have a binding death nomination?
Yes. It's next to the investment strategy they did 25 years ago.
And it's expired, probably. We'll move on from the paperwork example.
Yep.
Again, it's a bit like the trust. I mean, a self-managed super fund is essentially like a trust. the trustee needs to look. It is extremely complex when you consider the nature of binding death nominations versus non-binding death nominations, and what the trustee needs to do in assessing the way that superannuation is distributed out. They need to take into account dependencies. They need to take into account length of time of dependencies. So a key thing would be to listen to your financial advisor when they're talking to you about making binding death and non-binding death nominations, because they are very, very important in narrowing the scope of what a trustee might need to do upon the death of a member.
And I think it is a really complex thing that we're coming across a fair bit. I think the nature of my clientele is we have the inexperienced party quite frequently we're working with, but occasionally we work with a couple and there is that imbalance. The self-managed super fund, I'm starting to think that if somebody doesn't have the ability or even sophistication to manage a fund on their own, there's almost an argument for them not being in the fund. Yeah, and I think it becomes a really, really complex question.
Very, very, very quickly moved out into they might still have some desire to have an active participation in it, but there are, I'm not going to cross over into spaces where I can be giving advice. You can talk to everyone about what.
We're walking a tightrope, aren't we? Yeah. And another issue can be if the self-managed super fund, if it only has one big asset, if it has a factory or something, liquidating the payout can be very hard as well.
Yes.
I've got a question here, and I think it might feel quite elementary to us, and it may not even be applicable to the people we're talking to, but record-keeping requirements. That seems just so fundamental that people should be keeping every record they have through this process. Is that fair to say?
Absolutely. For two reasons. One, to be able to demonstrate that they've acted with due care, etc., in fulfilling their duties. And secondly, to be able to pass that information on to beneficiaries that might ultimately inherit assets, where that information is extremely important.
I think that should play into your choice of executor as well, I suppose. I mean, we have people and we'll get them into the estate planning sessions, and they'll have 3 kids and they'll always choose one as the executor. And I always found that a bit sort of sketchy. But as I do more and more of this, I realize if you have one person in your life who's organized and can do this, rely on them, I think, because you don't want to make it too difficult. Look, let's quickly shift over to some of the tips and traps. I think we've covered a lot of these already, because I think it can be such a minefield and very complex. I've written this question, I don't know, maybe it's a bit unfair on people. Can people manage the taxation side of an estate themselves?
In a very, very, very non-complex scenario, yes. And what I mean by that is perhaps a family home that might pass to a surviving spouse, a bank account, a tiny little bit of bank interest. It's manageable. The recommendation always is, though, if there's a relationship with an accountant, that you should speak to them, make sure you understand the things that aren't obvious, and that might need to be considered before you just think, oh, this is a simple estate, I don't need to do anything with it. Once it gets into even small amounts of complexity, as you've pointed out before, Jordan, there's rabbit holes you can go down everywhere. And there are things that lots of people don't know what they need to be looking for and the right questions to ask. And that's where they need to seek advice so that they can be coached through that. And there should be, my biggest tip is to make sure that people engage and that they ask questions and that they are patient. Mm-hmm. And I understand that then makes them, they have to then shoulder that and then discuss with the beneficiaries. The only way to be able to go back to the beneficiaries and, make a case for why things haven't happened or provide updates is if they're asking the right person, if they can trust the advice that they're being given. It's going to make it a hell of a lot easier to talk with beneficiaries through the process.
I think it's a really, really good point. And you started that by saying that you should engage. And I think it's very empowering and it'll leave you feeling a lot better at the end of the process. But also just some of the most challenging cases I find are where they try to delegate everything to their professionals around them. Which, again, early on in my career, I thought, fantastic, we can just get the job done. But it's really not a great way to go about it. I think you want to be involved in it. You want to ask the questions, which means you have to be working with people with whom you are comfortable asking silly questions.
Yeah.
And
there
they
are
can
no
be
silly
really good.
questions. I mean, to be honest,
I think I've hit a few today, Phil. I think I've covered a few in this one.
we take for granted what we do know.
Yeah.
And we're very respectful of the fact that people, this is not anybody apart from what we do. It's not their daily thing. And it's dangerous to assume that you know a lot about it if you genuinely don't.
So I'm going to say that is the reason that I've asked you guys on this, because you are respectful of that and of that gap and that experience. That's not a universal experience. And I think that's a real pity. And that's across all the professions. But I think, yeah, you want that level of respect because people recognize it's a hard thing. This is a very weird question. We mentioned the deceased having maybe several tax returns that had to be done. What if they've lied in previous tax returns? So the tax returns have had falsified responses, or they just haven't been completely honest. What should the executor be considering in that case?
If the executor becomes aware of that, then the executor needs to consider the audit periods, the significance of the issue, and I suppose they're acting in the shoes of the deceased person in the sense that if they came across that, they will need to make amendments to the tax returns.
Which can have consequences for the estate, which is going to have consequences for the beneficiaries, which ultimately will have consequences at Christmas when you're all sitting around a table.
But the executor's got to remember that that's not them doing that. They didn't create the problem. They just need to do the right thing. And again, it is another one where you would very much need to consult not just an accountant, but a solicitor possibly. Again, there's quite commonly a relationship with both of those at the time through this process anyway. So, but just to discuss what the ramifications are, you need to quantify the value of the issues and understand all of the liabilities that might come from ignoring it. We would not advise to ignore it, though. It should definitely be discussed if you find that out.
And I think that also presents an interesting challenge for the executor when it's they discover their loved one has been doing some, questionable stuff. It can be a very difficult thing. Something we're finding is when maybe the investment decisions that the deceased has made over the years have been pretty subpar. That's a really hard thing for people to reconcile, that their loved one who they respected and thought they were in control of everything and knew what they were doing kind of didn't. Like, that can be a very sensitive path to walk as well. Look, on that uplifting note, we'll bring things to a close. But before we do, any final kind of thoughts or tips for people as they're navigating what is obviously a very complicated area?
Not from me, mate. I think I've covered off as much as I can, again, just by encouraging people to be patient and to ask questions and to understand that it's a relatively lengthy process when there's some complexity involved.
Yeah, I agree. I think the main thing is seek advice, and like even if you think it's not complex, go speak to someone like Phil or myself, because if it's not complex, we'll tell you that, and we're not going to do something or take your money for doing something that you can do yourself. We're pretty honest like that. We are anyway, and we will say that. So, but at least then, because there can be things in there that it might look complex to you, but there might be something in there that you're not aware of, because you only know what you know. So,
I think that's a great. I mean, you're talking earlier.
Sorry, Jordan. It comes back to that point about making sure you're doing the right level of due diligence as an executor.
Yeah.
I think when you were talking earlier about a really simple estate, you could do your own tax returns. I think it's really easy. Again, I'm thinking through the lens of, we talk to the people who aren't in the day-to-day running of things. They can think things are really simple because the deceased has been running two companies, a family trust, a self-managed super fund, and just really kept it separate. And then they could think it's a really simple estate, and then it all starts to open up. So definitely seek advice, find the right people to work with. But genuinely, on that note, I want to thank you both for coming on, because it is such a complex area. And for people listening, it's hard for us to talk about these things without straying into areas of advice or going to too much depth. So I think you guys have done a great job. So thank you. We'll wrap things up there. This has been Life, Loss and Legacy. Thank you again for listening. If you do have any questions, Daniel, where can people reach you guys?
We are in Port Melbourne. They can look out our website, spire-business.com.au, and they can email info@spire-business.com.au, and we are more than happy to respond there and talk more.
Fantastic. Thank you again. As always, I've been Jordan. Until next time, thank you for listening, and we'll see you in the next episode. Thanks a lot.
Thanks.